Hey guys, before you click away, let me show you something absolutely mind-blowing. If you started investing just $500 a month right now, today, you could potentially have over $1 million by 2050. I know that sounds crazy, maybe even too good to be true, but stick with me for the next 10 minutes because I'm going to break down the actual math, show you the real numbers, and explain exactly how compound interest can turn your regular monthly investments into serious wealth. And yes, I'll also tell you the catches, the risks, and what most people get wrong about this strategy. So grab your phone, open up your calculator app, and let's dive in. Alright, so here's the deal. I've been seeing a ton of videos lately about how to become a millionaire, and honestly most of them are either selling you some get-rich-quick scheme or they're just showing you fake numbers that make no sense in the real world. So today I want to do something different. I want to show you the actual calculation, the real expected returns based on historical data, and give you a framework that you can actually use to build wealth over time. Because here's the truth that nobody wants to hear: building $1 million is not sexy, it's not exciting, it's literally just consistently putting money into the market month after month, year after year, and letting time do the heavy lifting for you. So let me start with the basic scenario. You're gonna invest $500 every single month starting today in December 2025, and you're gonna keep doing that until January 2050. That's about 25 years of consistent investing. Now the big question is, what kind of returns can you realistically expect? And this is where most people either get super optimistic or super pessimistic. Some people will tell you the stock market returns 15%, 20% a year. Other people will say it's barely gonna beat inflation. So let's look at actual data. If you look at the S&P 500, which is basically the top 500 companies in America, the average annual return over the last 50 years has been around 10 to 11%. That includes all the crashes, all the recessions, the dot-com bubble, the 2008 financial crisis, the COVID crash, everything. Now that's not adjusted for inflation, so the real return after inflation is probably closer to 7 to 8%. But for this calculation, let's use a middle ground number that's realistic but not overly conservative. Let's say you can get an average annual return of 12% on your investments. Is that guaranteed? Absolutely not. But based on historical data from diversified index funds and the global stock market, 12% is a reasonable assumption for someone investing long-term in a mix of equity funds. So here's the math. $500 a month for 25 years at 12% annual returns. Now you can't just multiply 500 times 12 times 25 and call it a day, because that would ignore the most powerful force in investing, which is compound interest. Compound interest means you're not just earning returns on the money you put in, you're earning returns on your returns. Your money is literally making money, and then that money is making more money. It's like a snowball rolling down a hill getting bigger and bigger every single year. Let me break this down step by step so you can actually follow along. In year 1, you invest $500 a month, that's $6,000 total for the year. At 12% annual return, by the end of year 1 you'd have about $6,380. Not bad, you made $380. But here's where it gets interesting. In year 2, you invest another $6,000, but now you're also earning returns on last year's $6,380. So by the end of year 2, you'd have around $14,200. You've personally contributed $12,000, but your account is worth over $14,000. That extra $2,000, that's compound interest, baby. Now let me jump ahead because this is where your mind is about to be blown. By year 10, you've contributed $60,000 of your own money, 500 times 12 times 10. But your account isn't worth $60,000. It's worth around $115,000. You've almost doubled your money just from returns. By year 15, you've put in $90,000, but your account is worth around $250,000. And by year 20, you've contributed $120,000, but your portfolio is sitting at around $490,000. You're getting close to $500,000, and you haven't even hit year 25 yet. So drumroll please, by January 2050, if you invested $500 a month for 25 years at 12% average annual return, your portfolio would be worth approximately $1.06 million. Okay, I'm rounding up slightly. The exact number is closer to $1.05 million, but we're talking about $1 million. You contributed $150,000 of your own money over 25 years, and the other $900,000 came from compound interest and market returns. That is absolutely insane when you think about it. More than 85% of your final wealth came from your money working for you, not from you working for money. Now I know what some of you are thinking. 12% seems high. What if I only get 10%? Great question. Let's run those numbers real quick. At 10% annual return with the same $500 a month, you'd have around $660,000 by 2050. Still a huge amount of money, still life-changing wealth, but not quite $1 million. What if you get 8%, which is more conservative and closer to inflation-adjusted returns? You'd end up with around $475,000. Still incredible, but you can see how that return percentage really matters over long time periods. This is why I always tell people, fees matter, your fund selection matters, diversification matters, because even a 2% difference in returns can literally cost you hundreds of thousands of dollars over 25 years. On-screen text right here should say something like 12% CAGR equals $1.06 million. 10% CAGR equals $660K. 8% CAGR equals $475K. So you guys can see the comparison visually. Alright, so now you're probably wondering, okay, this sounds great, but how do I actually get these returns? What should I invest in? And this is where I want to be super clear and super practical with you guys. There are a few different approaches you can take. Option number 1, you invest in broad market index funds. This could be something like an S&P 500 index fund if you're in the US, or a total stock market index fund, or even a global index fund that gives you exposure to companies all around the world. These funds are diversified, they're low cost, and historically they've delivered returns in that 8 to 12% range over long periods. The advantage here is you're not trying to pick individual stocks, you're not trying to time the market, you're literally just buying a piece of the entire economy and holding it forever. Option number 2, you could invest in actively managed mutual funds or exchange-traded funds that focus on growth stocks or specific sectors. Some of these funds have beaten the market over certain time periods and delivered returns above 12%. The catch is they usually charge higher fees, and statistically speaking, most actively managed funds don't beat the market over long periods after fees. So you're taking on more risk and paying more money for potentially lower returns. Not my favorite approach, but some people like having that active management. Option number 3, and this is what I personally do, is a mix of low-cost index funds combined with some individual stock picks in companies I believe in long-term. So maybe 70 to 80% of my portfolio is in index funds, and the remaining 20 to 30% is in individual companies like Apple, Microsoft, Google, Tesla, whatever you're bullish on. This gives you the stability and diversification of index funds, while also letting you take some calculated risks on companies you've researched. But here's the key, you have to actually research them. You can't just buy meme stocks because someone on Reddit told you to. On-screen text here could say, Option 1, broad index funds. Option 2, actively managed funds. Option 3, index funds plus individual stocks. Make it real simple for people to see the 3 paths. Now let's talk about the elephant in the room. Taxes and inflation. Because here's the thing, when I say you'll have $1 million by 2050, that's $1 million in nominal terms. But what will $1 million actually buy you in 2050? If we assume average inflation of 3% per year, which is pretty standard, the purchasing power of $1 million in 2050 would be roughly equivalent to about $477,000 in today's money. Still a huge amount, still life-changing, but not quite as impressive as $1 million sounds right now. This is why I always tell people to think in real terms, not just nominal numbers. And then there's taxes. Depending on where you live and what type of account you're using, you might owe taxes on your gains. In the US, for example, if you're investing in a regular brokerage account, you'll pay capital gains tax when you sell. If you're using a retirement account like a 401k or an IRA, you might not pay taxes until you withdraw the money, or in the case of a Roth IRA, you might not pay taxes at all if you follow the rules. So account selection matters a lot here. Personally, I max out my tax-advantaged accounts first before putting money into a regular brokerage account, because why would I volunteer to pay more taxes than I have to? Another massive factor that people overlook is consistency. This whole calculation assumes you invest $500 every single month for 25 years without fail. But life happens, right? You might lose your job, you might have an emergency, you might need to pause your investments for a few months. Or on the flip side, you might get a raise and be able to invest more than $500 a month. Even small changes to your monthly contribution can have huge impacts. If you could invest $600 a month instead of $500, you'd end up with $1.27 million instead of $1.06 million. If you could do $700 a month, you'd have $1.48 million. The math scales up really quickly because of that compound interest effect. Let me put another on-screen text here that says $600 per month equals $1.27 million. $700 per month equals $1.48 million. Every $100 matters. People need to see how those small increases compound. Now I want to address the biggest objection I always get when I talk about long-term investing. People say, but what about market crashes? What if I invest right before a massive recession? And this is a totally valid concern. We've had major crashes in 2000, 2008, 2020, and we'll definitely have more crashes over the next 25 years. That's just how markets work. But here's the beautiful thing about dollar cost averaging, which is what you're doing when you invest a fixed amount every month. When the market crashes and prices drop, your $500 buys more shares. When the market is high, your $500 buys fewer shares. Over time, this averages out and actually protects you from trying to time the market. Let me give you a real example. Imagine you started investing $500 a month in January 2008, literally the worst possible timing right before the financial crisis. The market crashed by over 50% that year. It would have been terrifying. Your account value would have dropped significantly. But if you kept investing that $500 a month through the entire crash and recovery, by today you'd be way ahead because you were buying shares at fire sale prices during the crash. This is why the people who panic and stop investing during crashes are the ones who lose money, and the people who keep investing consistently through the ups and downs are the ones who build wealth. I also want to talk about what happens after you hit your goal. Let's say you successfully invest $500 a month for 25 years and you reach that $1 million mark in 2050. Now what? Do you just cash out and spend it all? Hopefully not. At that point, you could potentially live off the returns without ever touching the principal. If your $1 million is still invested and earning returns, at even a conservative 6% withdrawal rate, you could pull out $60,000 a year to live on while your principal keeps growing. This is the concept of financial independence, where your investments generate enough income to cover your living expenses. All right, we're getting close to the end here, and I want to make sure you actually take action on this, because knowledge without action is completely useless. So here's exactly what you need to do. Step 1. Open an investment account if you don't have one already. This could be a brokerage account, a retirement account, whatever makes sense for your situation. Step 2. Set up automatic monthly transfers of $500 or whatever amount you can realistically afford from your bank account to your investment account. Make it automatic so you don't have to think about it. Step 3. Choose a diversified low-cost index fund or a mix of funds that match your risk tolerance. If you're young and have 25 years, you can be more aggressive with stocks. If you're closer to retirement, you might want more bonds. Step 4, and this is the most important one, do not touch it. Do not panic sell during crashes. Do not try to time the market. Just keep contributing month after month, no matter what's happening in the news. Final on-screen text here should say, 4 steps, open account, automate contributions, choose low-cost funds, never stop. Make it super actionable for people. Now, if you want to go deeper on this stuff, I actually put together a complete course that walks you through portfolio construction, fund selection, tax optimization, everything you need to build wealth through investing. I'll put the link in the description below. It's not free, but it's way cheaper than hiring a financial advisor, and it'll save you years of trial and error. I also have a free portfolio tracker spreadsheet that you can download. It'll help you monitor your investments and calculate your returns over time. That's also linked in the description, completely free. Just grab it and start using it today. And look, if you got value from this video, do me a huge favor and hit that subscribe button and turn on notifications, because I make videos like this every single week breaking down personal finance, investing, building wealth, all that good stuff in a way that's actually useful and not boring. I'm trying to hit 100,000 subscribers by the end of next quarter, and I can't do it without you guys. So subscribe if you haven't already. Also drop a comment below and let me know, are you already investing consistently or are you just getting started? I read every comment and I love hearing from you guys. Before I go, I have to include this disclaimer because it's legally required and also just the right thing to do. I am not a SEBI-registered advisor. All content is for educational purposes only. Past performance is not indicative of future results. Do your own research before investing. Seriously, don't just take my word for it. Do your own homework, understand what you're investing in, and make informed decisions based on your own financial situation and goals. Alright guys, that's it for today. Thanks so much for watching. I'll see you in the next video, and remember, boring investing done consistently beats exciting gambling every single time. Peace.